and welcome to BloombergQuint. It's all talk economic here on the show over the next half hour or so. We're talking about the economic survey, but actually we will also briefly get a view in on the revised GDP numbers for FY19, where the growth numbers have been revised down to 6.1% from 6.8% earlier. Joining us on the show today, Renu Kohli, independent economist and former staff member of the IMF, Shubhada Rao, chief economist at Yes Bank, and Suvodeep Rakshit, senior economist at Kotak Institutional Equities. Thank you all so much for joining us. Appreciate it. Shubhada, I'm going to come to you first because I want a view on these GDP numbers that it came in before I get to the economic survey. This is a sharp downward revision. Did you get a chance to glance at the data to give us some insight into what happened?
I think, last 2 or 3 years, they've been recalibrating GDP revisions fairly frequently. So to get a proper handle whether, it's obviously being led by a manufacturing and services sector downgrading of growth. But overall, I need to read it in greater details as to, what underlying factors are they ascribing to for this downward revision. So, when I look at all the past few years of recalibrated annual GDP numbers, I think one needs to go far back in history of about 7 to 8 years, and then perhaps put it on one scale to see how it's panning out and what are the underlying reasons. Obviously, investment-led slowdown would be one of the factors, because we all know investment has been on a softer momentum for a fairly long time now, and that could be one of the leading factors for the downward revision in terms of growth numbers.
All right, Shubhada, I won't pin you down any further on that because, to be honest, I haven't looked in great detail into the numbers either. So let me get straight to the economic survey. Renu, thanks so much for joining us. The survey actually came against the backdrop of, weak growth, and there was an anticipation that, or there was a hope that we'd get some great insights into what's going on. Their basic assessment seems to be that this is a financial sector problem feeding into the real sector. Renu, do you agree with that?
Both yes and no. Yes, because definitely there is no doubt about it that the NBFC crisis last year has pulled down the economy even further than it was already. But going back to the previous few years, and the fact that the banking sector crisis has remained and festered for so long, elevated unresolved bad loans have remained in the system for so long. So that has definitely undermined and delayed the output recovery. And to that extent, I think just to sort of ballpark or to think that it's just the NBFC crisis or the financial meltdown last year is responsible for pulling down growth is a partial kind of an assessment. That said, it is fairly sober in terms of its GDP outlook. Although even at my own professional assessment, even 6.1 to 6.5% next year does not, to me, it appears very optimistic, and there are many forecasts which are not even touching 6% for next year.
Suvodeep, same question to you actually, along with your understanding of whether this estimate of 6 to 6.5% is realistic for next year, and what it could mean for the nominal GDP numbers that will be used tomorrow in the budget to underpin all the expectations on tax growth, etc.
It seems slightly higher than what we were expecting. Obviously, we have a 5.5% for FY21. I'm sure they would have taken a fair amount of base effect. So yes, even if we look at the base effect, I think it will be somewhere around 50 bips in terms of when we are projecting the next year's numbers. So 6.5, slightly optimistic, but I think somewhere they are also trying to link it to the fiscal space. When they are talking about in the economic survey, they are also mentioning that there should be a counter-cyclical fiscal policy, which will increase the headroom for the fiscal space and everything. So I think somewhere they are trying to signal that there is some amount of fiscal push that is going to come through. Possibly that is what it's pushing that to the growth rate towards the 6.5%. but still it seems on the higher side. Obviously, if we take a 6 to 6.5% real GDP growth, the nominal GDP growth is closer to 10.5, 11%, which is, you know, a kind of normal assumptions that you would take in a year in terms of the budgeting exercise. But frankly, I think next year also the challenges will be significantly high, and you know, the nominal GDP growth that I think realistically is possible will be sub 10%.
Shubhada, did you read a subtext in the economic survey's fiscal chapter, or at least the macroeconomic outlook, that they will obviously, you know, I think FY20 will be very, very tough to meet, anywhere close to 3.3. But do you think the dominance of sort of fiscal prudence in the FY21 budget will also reduce? Did you read between the lines to suggest that?
I think what we are picking up from the chapter is, of course, that fiscal 20 breaching of fiscal target is almost given. In fact, our own estimate is almost absolutely up to 0.5% of GDP, which is 3.8. And going into the next year, they are going to clearly recalibrate the fiscal consolidation path. Our opinion and what we pick up from the chapter is probably it would be a redefined path. Somewhere close to 3.6 would be my estimate that they would put out for fiscal 21. That's, of course, reading between the lines, but they do acknowledge that there is always a risk of crowding out of private investment because of the fiscal dominance, and that taken point from there on, we believe that there would be a reconsolidation path to be defined, but not very dramatic. It would be from 3.8. If it comes out for the current year, it could be about 3.6 for the fiscal 21. That's our assessment.
Renu, you know, in one of your pre-budget articles which you wrote for BloombergQuint, you talked about the need to, you know, sort of reform the expenditure side. They do briefly allude to that and say that, you know, we need to relook at the food subsidies in particular, which is the largest component. So, you know, heartening to hear that for you.
Yes, I'm not so optimistic because it's actually, you know, pruning subsidies or, you know, any kind of a radical overhaul of major subsidies, particularly the food subsidy, is more of a question of political economy, and a lot depends on political will, how it is presented, and the context in which it comes. Unfortunately, the times are extremely constrained and hard right now. You know, a good time to overhaul the food subsidy would have been, you know, when we had these exceptional oil revenue windfall. That was a very good time for a major overhaul. However, you know, in the past we have seen that there is really never any one-to-one or even the, you know, like sort of least correspondence between what the economic survey says and what actually occurs on the is presented in the budget on the next day. So from that perspective, I am not so optimistic. It is possible that some bit of it may be rolled over to create some kind of a fiscal room, but that is standard. That happens all the time each year. But the fact that the thought and the very idea has been put forward in the economic survey is a welcome development, because there has to be a vigorous debate in public discourse about this, and it is unfortunate that this hasn't really come about, particularly because if we can see the counterproductive effects of massive public expenditure which have set in the last 2-3 years. And I would just want to touch on the previous questions and add to what Shubhada said about the fiscal, you know, subtext. I find it a bit disjointed because all the fiscal indicators that have been presented in the economic survey are very much drawing upon, you know, on the budgeted estimates of FY20, that is 19-20. So, you know, you see this huge debt reduction coming down from in public debt, and that seems pretty unachievable to me. because the interest rates have remained fairly high and the nominal GDP has gone down. So obviously, that will affect the level of public debt. And if we just see the IMF staff report just on December 19, it shows basically general government public debt at close to around 70% of GDP. I think 69.7 or something, that's the number.
Sure.
So, it talks about crowding out, but at the same time, if you see the projections of 6.1 and 6.5, where is that growth coming from? A lot of it is coming from public investment, and it is talking about, so many trillion of mega investments in infrastructure and all, but we all know that so much of investment in infrastructure has taken place, but it's not really producing any growth outcomes. Rather, those are adverse.
True, absolutely. Renu, you just warned us about reading into the eco survey too much to give us a sense of what's coming up in the budget. But I do want to pick up on one thing, and Surjit, maybe you can come in on this. The budget in the fiscal chapter, the economic survey in the fiscal chapter talks about state finances. It seems to make the argument that, the higher devolution to states that the last Finance Commission had put out has been largely used up for revenue expenditure, not capital expenditure. Tomorrow, the final or the interim recommendations of the Finance Commission will also have a bearing on the final fiscal number?
Yes, in fact, I was hoping that you would be touching upon the 15th Finance Commission part, because it's important to note that if they are changing the tax devolution percentage, which was 42%, if they are reducing it, and I don't know what the final thing will be, but it's just a conjecture that if they are reducing it, that gives a net tax revenue benefit for the center, and that opens up some amount of fiscal space. Having said that, obviously, the expenditure side also needs to be recalibrated, where they are going to spend, whether it's rural spending or whether they're giving income tax cut and all. That's a secondary thing that you think about. But concentrating on the 15th Finance Commission part, I think if there is a benefit that comes to the center, then obviously the center will be in a better position than what we are expecting, and because all our numbers are currently based on the 14th Finance Commission expectation or the recommendation that they had given out. The second part that you're talking about in terms of the state government, the point is that it was supposed to be unhinged in terms of, in some sense, the states are free to do and how they want to spend it. The point on the revenue versus the capital expenditure also comes in, because the revenue expenditure part, the increase in the revenue expenditure would be also reflective of the farm loan waivers that have come through by various states over the last few years, especially since the 14th Finance Commission put forward its recommendation. There have been a spate of farm loan waivers which would increase the revenue expenditure. So from that perspective, I think it's important to note that even if the states wanted to do capital expenditure, I think the political economy wanted something else, and that's what is reflective in the revenue versus capital expenditure, even though the states have been getting a higher share than what they used to get earlier.
Sure. No, I was just wondering whether, they were sort of trying to make the case for lower devolution to states. But I'll just move away from that and talk about some of the other slightly theoretical chapters. Shubhada, they seem to be suggesting, a new model for divestment. I know a lot of economists have been saying that one way to free up fiscal space is to divest far more actively. Do you think the structure being suggested is something that's worthy of consideration?
I would think that is one of the key most agenda items that this government should actively pursue, that is of divestment, and change the track from divestment to actually strategic sales. And that is the only big revenue item that we can identify going forward, which is going to free up sizable government capital, in the whole process. So I would think that of the 5 or 6 big ideas that the economic survey puts out, I would put the key ones would be, first would be strategic sales. I would prefer to use the word strategic sales than the divestment, because I think we need to have some thinking afresh as to we just want to dilute it by 5, 10, 15%, or use this opportunity to go lock, stock, barrel in many of the sectors as a strategic sale. Second, I would think is the fragility of NBFCs and how the government intends to do away with the risk aversion coercion that the financial sector has at this point in time. And the third would be, of course, the ease of doing business. I think they have articulated on 3 or 4 points, but one point I believe that we really need to work upon is the enforcement of contracts, and I think India has been fairly lagging on that metrics, and one needs to put that up front. That will actually on the ground improve the ease of doing business. And last but all umbrella, all permeating factor is the jobs creation. So out of the 7-8 items, big ideas that the economic survey is trying to put out, I would essentially prioritize these 3 or 4 as critical items that the government should, going into fiscal 21, pursue with a timeline, because strategic sales, the plan and action needs to start well ahead in the fiscal year and not leave it into the second half of the fiscal year, because that just doesn't leave you enough time to plan and get the whole program going. So execution is the key, and that has always remained a sizable problem as far as the measures to execution is concerned. So I think government needs to focus on actions ASAP on all of these fronts.
Shubhada, I'm going to have a rare, once-in-a-lifetime disagreement with you. I know they had said a lot on financial sector, but they suggested precious little, and maybe I'll come to Renu on that. Renu, on NBFCs, they talk about this health score. I mean, sure, good to have a health score for NBFCs, but the problem has already happened. On banks, they talk a lot about the underperformance and the inefficiencies of public sector banks and end up recommending fintech and ESOPs to resolve that, although Sanjeev Sanyal just talked about sort of netting, bilateral netting as a big way to release capital. Do you think there are enough ideas in there on the financial sector if they feel that the financial sector is the biggest problem? Renu, to you on that?
No, I don't think that there are any ideas. Number one, on the public sector banks, frankly, it's very disappointing that, given the chapter on privatization and all that Shubhada talked about, and I endorse that, which is the privatization of public sector banks. I mean, it is crying out for efficiency improvements. It refers to all the reports, P. Janayak, and all those things which have talked about governance improvement of functioning. And all it says is to improve their functioning and bring about efficiency enhancement, is to move towards fintech and better, use data analytics, etc. So it's very clear, the message is very clear, at least from the standpoint of what we can glean from the economic survey, that privatization is just off the table, and any improvements in the public sector banking system has to come through that. It compares a lot about size, scale and all, but the current problem, or rather the festering problem for the last 5-6 years we are facing, is the weakening of the public sector banks, the withdrawal from the credit market altogether, risk aversion and large levels of NPAs. So it doesn't correspond to, it does not really is not really relevant to the current economic problem in the public sector banks. The second thing is about the NBFC. It's good. It has built developed an indicator and all. But let's just rewind back to 2013-14. If you see the figures, and just the biggest giveaway figure is gross NPA as percentage of assets or advances. This was already on the rising path from, in the last 3 years, 13, 14, 12, 13, and so on. So when the banks retreated from lending in the post-2014 period, NBFCs were very much encouraged. And if you see the series of reports and trends and progress in banking and the financial stability reports, right up till December 2017, it's only in last year, in December 2018, that the tune of the FSR and the RTPBI changed. They were actually looking at it and endorsing it as a very welcome development, that the NBFCs have filled up the space and the vacuum created by the bank's retreat from the bank credit market and filled up that lending vacuum. But the fact that credit was pushed through NBFCs, and particularly the vast exposures in real estate, it was going on all the time. It's a huge failure of supervision or regulation. So, you know, the NPA ratio itself, the gross NPA ratio itself is a very telling indicator, and it was already there. If NPAs, if your gross GNPA figure is rising, it's time to see, and if your credit is rising at a very rapid pace, which was happening in the NBFC sector, the signs were all there.
Right, I would tend to agree that I don't think a health score is, something that was missing in India. There were various ways to look at it. Suvodeep, your thoughts on both these aspects, the divestment part, which I did think was interesting, and the lack of any real solutions on the financial sector, despite identifying it as a key problem.
Yeah, I mean, see, when it comes to the privatization part, proposing a new model on the lines of the Temasek holdings and getting it going in India, of course, it will, first of all, it will take some time to set it up, get that entity with the board members and everything going. And then you kind of start with the divestment process, whichever way, I mean, CPSC or otherwise. But the point essentially is that, again, you come down to the bare fact that execution and implementation will be key. Even within the current structure, it's the execution and the implementation in the sense that when you're talking about a divestment pipeline, why not start from the very first of the year, and why wait for the the second half of the year? So in some sense, it's an execution and implementation issue. Even if a proposed new structure on the lines of the Temasek holdings of Singapore is kind of being proposed, it's a good concept. I mean, as a concept, it's a good concept because it introduces professionalism, and it can actually have potential benefits. But again, I come back to the same point that it has to be on execution and implementation. Secondly, on the financial sector, I think, I mean, if it was, and I agree with Renu and Shubhada on this, that if they wanted, they could have mentioned what's the next step with the banks and what should be done with the banks, because they, in some sense, they also have talked about how a private sector bank and a public sector bank and how different they are in terms of the returns on various parameters. So I think from that perspective, they could have mentioned, the survey could have talked about what's next for the public sector banking space, because the mergers are done. What's next to get them to lend again? NBFCs, I think it's somewhere or the other, the health score, I agree with you that it's a score at the end of the day, and there are various other indicators one can look at. For the simplest thing, that if you look at the liquid mutual fund debt and what the liquid funds were doing, the kind of AUM increase it had seen, that would have been an early warning indicator in the very first place. So it's helpful to have this kind of a scorecard going into the next cycle, but it's not a solution in some sense how to tackle the current solution, whether it's a bad bank or whether it's some kind of recapitalization that is required. So I'm not sure. I mean, I was hoping that there would be more in terms of the banking and the NBFC sector, and to get the credit going again to boost growth. But I think that is a link that seemed to be slightly missing.
Fair enough. All right, last round of questions, Shubhada, to you. And sorry, I didn't mean to counter your point on the big takeaways in the economic survey. This is a little bit of my pet peeve, so I was taking on that issue. But over to budget day, Shubhada. What's the final word? Will we see a big bang announcement kind of budget? Will we see a budget which will sort of keep on the path which was set in July, which may be the better thing to do?
I hope not on the path of July, because point one, we need a more credible math on the fisc side while presenting the budget. So very clearly we need, believable numbers. That's most important. Second is, I think we are putting too much on the budget day event. I think since July, we have seen more of budget making in the ensuing months than on the day of the budget. So am I expecting seriously big bang? Probably not. I think if they put 2 or 3 big ideas, I wouldn't even call them big bang reforms, but if they put 2 or 3 big ideas which actually can be executed and implemented, particularly on the side of investment push, I think that would be a good starting point, because at this juncture, what India really needs is, an investment-led, consumption, subsequent-led growth that should pave way for getting up to a 6%. I do agree that 6 to 6.5 at this current juncture looks a tad optimistic. Our own estimate would be at 5.7. But in terms of reforms, I would just expect them to put those ideas on the table of execution, like a national infrastructure pipeline. What am I expecting out of it? What is the funding coming from? What are the sectors that are going to be looked at? What is the policy framework? I think we need reforms which are not comprehensive alone, but they need to be complementary also. A corporate tax cut, if it is accompanied with land labor reforms, etc., then makes a solid case of capex revival. But if it's a piecemeal approach, then the whole story and the whole plot is somewhere missing. And I would look at more complementarity aspect of reforms that would hopefully put the economy back on growth path, say up to 6% going into the next fiscal year.
Renu, what would you like to see tomorrow, particularly on the fiscal deficit front, and any specific areas of focus?
I think it just boils down to just one thing. It reduces to resources. There is no money, and in that light, any kind of announcements, etc., would could be aimed at a kind of revival of or boosting sentiment, confidence. But I think matters have gone too far now, and the state of economy is really bad. There is an intense resource crunch. So I think the wherewithals are just not there. A revival strategy in bits and parts isn't what is required as of now. A coordinated, package, or a coordinated look macroeconomic thing with, part of monetary, fiscal, external sector, that is trade policy and exports, and it's something one can be looked at. But then, we are having a rise in import restrictions. We are having, more and more interventions and controls. So, that kind of coordination we have not seen. So I would not expect that tomorrow. I'm very curious to see as to how the arithmetic is reconciled, because that's where all the thing. But with all that situation, I think from a policy making standpoint, the only thing that the government should be actually looking at is how would it respond to if there were any kind of adverse shock? What are the tools that you have? What is the space that you have? And that's what is to be looked at in terms of, going forward.
Sure. So, Suvodeep, last word to you from the markets as well. There'll be just two numbers. They'll probably be watching what last year's deficit ended at, what next year's will be, and I'll throw in the debate around the escape clause. Not everybody agrees that that escape clause could open the door for, direct deficit monetization. But should that actually be on the table, that would be a shocker.
I agree. I mean, see, just to give a very brief perspective that, all the measures that we've seen since the July budget in various sectors have been more on the supply side. So I think the government has already taken a call in some sense that the supply side is where the effort should be. Now, going into this budget, we've seen a deep slump in consumption. And if you look at the economic survey, they've also mentioned this particular aspect that consumption has been boosted or kind of supported by entirely a fall in households' investment in real estate. So it's kind of that income generation has not happened, and hence you've had savings being eaten into to fund consumption, and obviously there's a leverage consumption part. Now going into the budget, you've already seen a series of supply side interventions. The point is that whether the budget can give some select focus demand side solutions. So and this does not mean that this is the end all of consumption stimulus or investment growth or anything like that. All I'm trying to say is that for the time being, there is a need for consumption to be boosted. And for the longer term, obviously the plan is very clear to get investment going, and hence which will create that virtuous cycle of growth and consumption, etc. So now the point is that this budget specifically needs to focus on this income generation or transfer, or in some sense, getting the consumption, possibly consumption at the rural sector going. Now, for that, of course, resources are extremely low and fiscal headroom is limited, which brings me back to your point that, when you're saying that escape clause, we all keep making that point that escape clause, and hence the primary, the RBI can get into the primary market of issuances and all. But the point is, it's supposed to have a fiscal council which will dictate whether the escape clause can be activated and how much of slippage is being done, and hence whether that the whole RBI buying into the primary, or getting into the primary market and all happens. We don't have a fiscal council yet. But still, I think we'll possibly see a slippage from 3.3 to 3.8% in the FY20 budget. But I think in absence of that fiscal council or clear guidelines, in the sense that taking such a drastic step by the government, I don't think they'll probably get there in terms of the RBI coming and directly participating in the primary issuances. So I think there is a slippage that is happening to the extent that escape clause allows. But I think the RBI is not possibly being will be a participant in the the borrowing and the primary market issuances that happen.
All right, really hope that's the case. Thank you all so much for joining us and spending some time with us here. The economic survey, a big document, tough to do justice to it in a quick show, but those are some initial thoughts. Do go to BloombergQuint.com. We've got a lot of the key takeaways up on the website as well. Thanks for watching.